Welcome back, America. Hugh Hewitt inside the Beltway on a gray and cold day. Now, it's really gray and cold if you're an investor in AI and NVIDIA and Palantir, but not because of my next guest. David Bahnsen tried to warn everyone. He did a Dividend Cafe a few days back that I've been talking about online and on air since. David, welcome. Yesterday when the market closed, I breathed a sigh of relief because I knew you were coming on today. And NVIDIA posted great earnings, and I thought, okay, David will be able to tell people how to unwind their positions before the bubble bursts. But I sure don't like what I'm seeing on Wall Street today. What do you make of it?
Well, one thing I'll do, and it's not out of false humility, but it's just to set the record straight that we don't ever think we get something right or wrong in one day's activity. To the extent that there's really big concerns with an AI bubble, they're more than what's happened the last 2 weeks, and they're more than what's happened the last 2 hours. You know, I have a much longer term view of a lot of the risks and pain that can take place and what has, happened out of this AI mania. If NVIDIA had closed up 5% today, I wouldn't feel any differently whatsoever than I do. And by the way, Hugh, even that, I said it on CNBC early this morning when NVIDIA was still up. NVIDIA was up 5%, but it was nowhere near where it had been 3 weeks ago. And you cannot print a better quarter than they just printed. And to still not get back to a new high is actually a very bearish thing, especially for those who take market technicals seriously, which we don't. But what you're seeing with Palantir down now $50 from its high of a few weeks ago, and NVIDIA on very, very strong quarter declining intraday, is what happens when everything is good at the company except for its price, where it's too gosh darn expensive. That's what's happening.
What you explained for me is that euphoria can overtake investing. And when that happens, euphoria leads to bubbles, and you can hold two thoughts. This is a great company, and it's overvalued. This is a world-changing technology, and it's too soon to say everyone's a winner. And when you got me at railroads, I sent you a note. You had me at railroads, because that is the perfect analogy, 1850s, 1860s. A lot of railroads everywhere in the industrialized world. Some of them made an enormous amount of money for their investors. A lot of them went bust. What is your advice to people generally listening right now about unwinding their AI trade or about the fallout if the AI slide continues?
Well, I think that every individual has to have a particular allocation that's appropriate to their risk level, to their age, to their income need. So there's a lot of factors that require a personalized, customized portfolio. But where AI fits into that has to be a byproduct of all these other factors. What's happened, Hugh, and what I wrote about is that no one's thinking about any of those things. They're just thinking, this is free money. Why would I not buy this? It keeps going up, and the reinforcement for it being a good investment is that it just got done being a good investment. That is not an argument for future returns. It is a description of past returns. So anyone can agree with the math that NVIDIA has had XYZ return over the last 3 years. It was a $1.5 trillion company, which was very, very big. And then it went to a $3 trillion company, and then it went to a $5 trillion company. And if people believe it's going to be a $7 trillion company, if they think it's going to become 1/3 of the US economy and be a $10 trillion company, then be my guest. I don't believe that. But the argument that it will become such just because it has been having good returns is not a cogent argument. So I want investors to think a little bit more wisely about what drives future returns. What drives future returns is successful companies generating profits, innovating. NVIDIA does that, but it's also the price you pay for it at entry. And the greatest example, and forgive me for going on so long, Hugh, but we own a company called Cisco in our portfolio. I think we're up about 400% over 13 years, and it's grown its dividend every year. But it's sitting right now in the mid-70s. And we bought it at around 20, 15 years ago. You know what Cisco was in 1999? $86.
No. Wow.
And you know that Cisco has grown its profits every single year for 25 years. Cisco didn't go down because the profits fell. The profits didn't fall. Microsoft was down for 15 years from 2000 to 2015. Microsoft wasn't dropping in profits, dropping in margins, dropping in market share. They were world dominant, but the price was too darn expensive. That's, I think, the risk people have with some of these things. So there's a lot of complexity in this AI story. I'm not trying to be a doomsdayer, but for it to become 100% of someone's portfolio, 70%, 40%, I'm not sure that's prudent for most investors.
I agree with that. Let's turn to the second subject. The fallout to the broader economy, if in fact an AI bubble is deflating right now, and there's good evidence that there is that sort of deflation going on, not a panic, just a sell-off. And what is the impact on everything else in the marketplace in America?
The best case scenario, and right now I'd call this a base case. So we always start with a base case, it's the highest probability, and then you look at tail risk, where it could get better than base case or where it could get worse, okay? The base case would be analogous to .com. People got their faces ripped off in the year 2000, but most of America didn't even know it was happening because the people who got their faces ripped off were the risk takers who owned pets.com after a Super Bowl commercial and wrote it down to zero. Where you get a systemic, contagious problem from a bubble bursting is like what we all went through in 2007, 2008, where it bleeds into the banking system, where there is a big credit default situation. It's a debt-fueled bubble. Most of this AI story so far has huge exposure from the hyperscalers that are equity and cash payers. Your Metas, Googles, Amazons, Microsofts that have been giving NVIDIA hundreds of billions of dollars. That would not be good for that thing to unwind, but it would not be systemic at this point. Where it can become systemic is if it becomes more debt-fueled and if this data center build-out gets ahead of itself. That's your railroad example. The railroad thing was not just that some railroad stocks went to zero and some went up. It's that the whole US economy suffered because there was a massive amount of malinvestment, of excess investment into rail. If we get excess investment into AI, and then we're underinvesting in industrials, in machinery, in healthcare, in R&D, and other elements of the real economy, that's what drives me crazy about this, is we went through this with the internet. We underinvested in biotech so we could go buy pets.com, and then we had to spend 20 years getting caught up with pharmaceuticals. It's embarrassing.
Well, you know, bubbles are inevitable. They are a feature, not a bug, of free markets. But what I want to know now is more personal, David. How much time have you had to spend on the phone today or since you put out the Dividend Cafe on the AI bubble, consoling, counseling, guiding customers?
Not one single minute, not 1 second. We don't have any of this AI bubble in our portfolio. We've spent more time this year on the phone talking to clients as to why we don't own it, but we haven't spent any time consoling anybody because we're very blessed. Our clients buy into what we're doing, and what we're doing is dividend-focused, cash flow-focused, more reasonable, more fundamental. And that's just the way I tend to manage money and think about things. But having to deal with panicked clients is only a problem if the clients don't understand the expectation. So when I'm thinking about a lot of people out there that are not clients of mine, but I still care about, like I'm still a Christian human being who cares for my neighbors, right? I don't think very many people bought the S&P 500, Hugh, believing it was going to be 40% in 10 companies, believing it was going to be over 40% in technology and communication. You know, when that bust happened at the end of 1999, 2000, a period I'm sure you remember well, that media, technology, telecom, that was 25%. Okay, we have far more concentration risk in investors right now that think they're diversified, and I'm not sure that they are.
So my last question, David Bahnsen, and people can go to the Dividend Cafe, go back 6 days and listen to the AI Bubble episode David recorded, and watch it actually, because his facial expressions are very useful to understanding what he's saying. but you can listen to it and you can get their daily updates by subscribing, and you can read David's work all over the place. He's a very fine public intellectual as well as being an investment counselor. Is how long until we're in the clear, in your view, meaning that whatever's going to happen has happened and the market can begin to revalue assets correctly? Arthur Brooks once told me it took 20 years to clear the windshield after a panic. This isn't a panic, it's a bubble. But how long until you get normal again?
Well, you really can't time the beginning of, the end of when you get normal until you have started the beginning. And I'm not sure that we have clarity yet. You still are trying to see companies announce these circular deals. Just yesterday, Anthropic announced they're going to give $30 billion to Google, who's going to give it to NVIDIA, and NVIDIA is going to give it to Anthropic, and then the market didn't go up at all. So you need that insanity to stop, and then we start the period of purging malinvestment. But where Arthur's right is that there have been bubbles that took 20 years to clear the deck, but there's been bubbles that took 2 years. And so then you get an average, but the tails are going to be far apart. Look, I think this thing is going to take a couple years. That we've never seen anything like this here. The amount of money that these companies have committed. Meta was spending less than 10% of their earnings on capital expenditures for years and years and years. That's why they scaled so profitably. Google as well. Two companies that were had barely any increase in expenses as they were adding more users and more revenue and more profits. They're spending over 100% of earnings on CapEx now.
Wow.
It's absolutely stunning, the level of zeros and commas that have gone into this, with very few people that are telling you, and here's our path to profits from it. Here's the ROI. What they're saying is, we'd rather be early than late.
Here's my my very last comment. There are a lot of, I'm not an investor. I sit on foundations that invest. A lot of investment advisors are not as cautious or as calibrated as you are, David. Do people go out of business as a result of things like this?
Well, you mean advisors or companies?
Yeah, advisors.
Some do. Usually if they have clients that are with them because they are chasing a hot dot and then the hot dot goes away, like in any business, the value proposition really dictates the durability of your business. If you have created a value proposition with clients based on long-term planning, investment philosophy that is sustainable and so forth, then you can ride through various up and down moments. But there were
As I'm sure you will, but I want you to come back in a couple of weeks and update us on that. The Dividend Cafe is where you go. Follow David Bahnsen on X @David Bahnsen. Thank you, David.
Thanks so much, Hugh. Appreciate it.